Welcome back. As investors brace for an economic slowdown, deal-making has slumped as the cost of capital has risen. So joining us here on set to give us her perspective on the landscape and where she sees opportunity, Sunaina Sinha Haldea, Raymond James, head of Global Capital Advisory. Welcome, welcome.
Thank you for having me.
So is that what we're seeing? Are we seeing deal-making slump? And if so, what's contributing to it, and does it continue?
Deal-making has slumped because you've gone into an unprecedented macro environment. Lower growth on the horizon, earnings recession coming through, high inflation. So corporates have pulled back in terms of their M&A activity. Private equity deal-making is interesting because that pulled back as well, because most private equity require functioning leverage markets, loan markets, to do their deals. And given the rising interest rate environment, we all know what's been happening on the lending side. So those deals have been on hold for a while, but certainly over the last 60 days, you've seen a comeback. It's almost $1.1 trillion worth of private equity capital on a clock to deploy, waiting to come out into markets and buy assets. So we're all on standby to see some of that come through in the second half of the year.
Yeah, I was actually speaking to the head of a large PE firm just earlier this week who said they're sitting on billions of dollars that they have not yet deployed. What is it going to take to see some of that actually start to happen? I guess those floodgates to finally open.
Well, I think you're going to see two things. The first is intrinsic to private equity, and the first is extrinsic. The extrinsic variable is, of course, the syndicated loan market. You need to see that starting to get more active, start lending becoming easier, and that's what's really going to play through into large cap buyouts playing out again. However, on the mid-market and lower mid-market of private equity, the folks that buy smaller businesses, that's already working well. There is this shadow banking, non-bank lending environment that is very vibrant now and very much seeing itself thrive as you see the banks pull back. One thing that's intrinsic to private equity that's a big floodgate is just the fact that investors require private equity firms to deploy capital. That's how you get the IRR and returns that private equity needs to show to raise their next funds. So they can't be on hold forever.
Keith Block from Smith Point was with us yesterday and said valuations for a lot of businesses haven't come all the way down to where they're probably going to. And I wonder, what's your perspective on why? Because economic conditions have gotten tighter. A lot of VCs have said, we're not going to fund every business. We're triaging those that we expect to survive. So wouldn't that pick up a certain degree of deal making, or has this rebound in the public markets in 2023 actually given some more hope and life to some of these younger businesses?
Well, all we can say is that bid-ask spreads, they take longer to come back together than one would think, right? So seller expectations still remained very high going into the back half of 22, early 23. Now you're seeing sellers temper their expectations a little bit, but not all the way. So to your point of why have valuations not come down, valuations only come down when the market starts to clear. And sellers have still said, listen, I want to hold on to my multiples. And when you see how the publics are trading 22 times forward for the NASDAQ, you can see where they get their expectations anchored from. And so that's the reason why you've had a big gapping in the market where buyers are saying, well, I'm not buying at those multiples. And sellers have said, well, I'm not selling. I don't need to right now. That stress, that liquidity, counterparty-driven stress hasn't come through on the seller side.
But that need to right now piece, is it like the commercial real estate market where you got to wait for the oxygen to run out?
Potentially. Depends on how bad the earnings recession would be. And that's the $64,000 question here.
Yeah. You were talking about shadow banking and the fact that non-bank lenders are kind of stepping in here, and it's a lot of opportunity, maybe even a field day. When I think about FSOC, for example, regulators here stateside, looking at the growth in that part of lending and saying, yeah, we're gonna have to think about this and maybe add some more regulation. What does that do to this entire equation?
I think it puts some guardrails around it, and that's not a bad thing. Anytime you have an industry come to critical mass, as this one has, and you have some regulation come through to put some gates around it and make sure it functions appropriately and efficiently. Nobody in the private lending, private credit side is averse to that. I think what we definitely have now is billions of dollars that have been raised into private credit vehicles that is stepping into the gap being left behind by banks. Certainly when it comes to mid-market, lower mid-market private equity deals, buyouts, they're certainly functioning using that market. It's the large end that requires a syndicated loan.
What do you think is the role of companies that have a lot of cash? Just some of these big companies that also have pretty healthy valuations. They have a lot of stock currency to spend. They don't need the credit markets as much as your ordinary company.
And a number of corporates are looking at this as a buying opportunity. Things that they thought were overvalued in 2021, they have come off a bit. Now, they may not have come off all the way, but this is a great buying opportunity for them. However, you do have boards saying rainy days might be coming, and to shore up balance sheets, go a little bit risk off, make sure that they have enough capital to spend on their own growth, organic growth plans instead of inorganic growth plans. That's why you've seen corporate M&A activity come off for the last 3 or 4 quarters. Now, if this continues to persist and we continue to have decent growth, by the way, we've been talking about hard landings for a while now. If that doesn't come to pass, they're going to want to spend that cash and use this opportunity to do some inorganic growth.
Quick question for you. What sectors are you seeing the most deal making or potential for deal making right now?
No question about it, business services. Tech-enabled services, business services, anything with an automation mode and a service mode is seeing a lot of interest and valuations being sky high. To your point, they really haven't come off, and those businesses are still going for top dollar. You're also seeing a lot of interest in industrials, back to old school businesses with cash generative profiles, recurring revenues. They're kings of this market. You're not seeing as much in consumer discretionary for obvious reasons as you go into this part of the cycle. That interest has abated.
Didn't say AI. You said automation and generative, but not AI. That's rare on CNBC these days.